Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Ric Dillon, who's the CEO of Diamond Hill Capital. Ric, great seeing you.
Thank you, good to be here.
You folks have an ETF that's quite unique. A lot of people think of the S&P 500, and we know the structure of the cap weighting index that's behind it. You took that and kind of turned it upside down. Tell us about that.
Yeah, so as opposed to a market cap weighted, what we do is use our model to estimate the intrinsic value of a company and use that times shares outstanding to come up with an intrinsic value cap.
So how do you determine an intrinsic value?
It's a discounted cash flow methodology looking out 5 years. All of our active strategies utilize this model, but we don't use any of our research from our active strategies. Instead, we use consensus data for that information.
So give me an idea on weighting. Is the weighting going to look like cap weighting to some degree, where you're going to have some securities that are going to be that much more heavy than others?
Yes, and so what you find is the largest company in the S&P 500, Apple, happens to be the largest in our Diamond Hill Valuation Weighted 500. It's just a different weight in ours versus the S&P 500. And so those different weights of the securities provide different returns. What we believe over the next 5 years will be something in the neighborhood of 50 to 100 basis points of higher returns than the S&P 500.
So companies that have poor valuation have a lot lower weighting compared to the S&P 500?
Yes, exactly. And so one thing that's different is that we, in our discounted cash flow methodology, we use a mean reversion of the capitalization rates. And what that means is that it's sort of from behavioral finance, the idea that higher valued companies move toward a mean and lower valued companies move upward toward a mean. So it tends to overweight undervalued stocks and underweight overvalued stocks.
Okay, so sounds complicated, but the great thing here is this is all wrapped into an index and it's rebalanced how often?
It's rebalanced monthly and it's reconstituted annually.
Okay, so although it's an index, there's still a little bit of movement back and forth based on the valuations, number one.
Yes.
And it's all available with one ETF. And
Yes.
the ticker again is?
Is DHVW.
Okay.
And it's as a passive strategy you would expect, and it has a 10 basis point total expense ratio, so it's a very low cost passive strategy.
But it's a way to, if you're very heavy in the S&P 500, that's the traditional legacy cap weighted, it's a way to diversify away from that if you're looking for a little bit more value, is that right?
Yeah, I think that it would provide a little bit more value, but it's really, I think, to be seen as a substitute for the S&P 500. We just think as a second generation, it's an improvement on market cap.
Okay, well great. Ric, thanks for stopping by.
Absolutely,
I really enjoyed
Tom.
it. Thank you.
You're welcome.